Ever feel like the stock market is some kind of exclusive club you're not invited to? Well, today we're going to tear down that wall. We're diving into the brilliant, common-sense playbook of a Wall Street legend, Peter Lynch. And we'll see how his ideas helped a group of 7th graders do something most pros only dream of: beat the market. So let's set the scene. Our story doesn't start in a flashy Wall Street office. Nope, it starts in a regular middle school classroom with some very, very unlikely financial whizzes.
Picture this. It's 1990. A teacher at St. Agnes School decides to run a little experiment. He challenges his 7th grade class to do what super smart, highly paid professionals do all day long: pick winning stocks. They didn't have any fancy software or business degrees. They just had, well, their own everyday experience.
So how'd they do? Over the next 2 years, the portfolio these kids built returned an absolutely staggering 69.6%. But honestly, that number alone doesn't even tell the whole story. It gets even crazier when you see who they were up against.
Okay, so let's put this into perspective. During that same time, the S&P 500, the big benchmark for the whole market, gained just 26%. That means these kids didn't just beat the market, they crushed it. In fact, they outperformed 99% of all professional mutual fund managers at the time. Let that sink in, 99%.
Which of course brings us to the million-dollar question. How on earth did a bunch of kids with zero formal training manage to just wipe the floor with the pros?
Well, the answer is all thanks to the simple but powerful philosophy of the guy who inspired this whole project.
You see, they had a secret weapon. And it was a single, game-changing piece of advice from the investing giant Peter Lynch.
This right here, this is the golden rule. It sounds so simple, right? But it's incredibly powerful. What Lynch was saying is that the best investment ideas aren't hidden in some complex report. They're often staring you right in the face, at the mall, in your fridge, on your way to work.
Now, the official term for this is invest in what you know. And it's exactly what it sounds like. It means that you, as a regular person, have a unique perspective. You see which new soda is flying off the shelves at the grocery store. You know which software your entire industry is suddenly scrambling to adopt. This is your edge, an edge that some analyst sitting in a skyscraper 1,000 miles away just doesn't have.
And this isn't just some nice feel-good idea. It's a real, practical advantage that you can actually use. So let's break down what that actually looks like.
Just think about it for a second. You see the restaurants that always have a line out the door. You notice what brands are suddenly all over your Instagram feed. You know which products your friends are obsessed with. This is exactly what the kids at St. Agnes did. They picked companies they knew and loved, like Disney, Nike, and Pepsi. That's real, on-the-ground research, and it can help you spot a winner way before it shows up on Wall Street's radar.
I love this quote because it really hammers home the need for simplicity. Lynch's point was, if you can't explain what a company does in a few simple sentences, so simple a kid could draw it, then you probably shouldn't be putting your money into it. Why? Because complexity can often hide a whole lot of problems.
Okay, so finding a great, simple idea is the first step. Awesome. But Lynch was very clear that this isn't a one-and-done kind of thing. Successful investing takes discipline. You have to follow through.
And this requires a huge shift in your mindset. When you buy a stock, you are not gambling. You're not just buying a lottery ticket and hoping for the best. You are becoming a part owner of a real business. And just like any business owner, you've got to pay attention to how your company is doing. So Lynch suggested a simple process he called the 6-month checkup. Every 6 months or so, you just revisit the story. You ask yourself, is the reason I bought this stock still true? Are they still making more money? Is the price still reasonable? Based on your answers, you decide if the story has gotten better, worse, or stayed the same. And then you act.
And the reward for all that patience and homework, well, it can be massive. Lynch's own research showed that over a 20-year period, a portfolio of good, solid stocks completely demolishes safer stuff like bonds. In his example here, the stock portfolio more than doubled the value of the bond one. It really shows that following the story pays off in the long run.
Which brings us to the final and maybe the toughest piece of the Lynch playbook. And believe it or not, it has very little to do with numbers and everything to do with human nature. This is one of Lynch's most famous lines, and for good reason. He was convinced that raw intelligence isn't what makes you a great investor. The real test is whether you can control your emotions when the market starts going haywire.
You know, Lynch saw people make the same emotional mistakes over and over. They'd chase the hot stock that everyone was talking about and then get burned. Or the market would drop 10% and they'd panic and sell everything at the bottom. His advice was simple. Expect downturns, ignore the hype, and just be patient with the great companies you've found.
So when you boil it all down, success in the stock market isn't about having a genius IQ. It's about having the emotional strength, the stomach, to stay calm, stick to your plan, and think like a business owner, not a gambler.
Peter Lynch's ideas empowered millions of regular people to take control of their financial futures. But it does leave us with a big question for today. In our modern world of AI and high-speed algorithms, can you still find that edge just by paying attention at the local mall? Does the amateur's advantage still exist? That's something to think about.